If you own a small business or real estate of any kind of size, here are 5 tax strategies that you need to know and be familiar with, and make sure they're used and employed in your business or in your real estate portfolio. My name is Roger Ledbetter. I've been a CPA for just about 20 years, and I work strictly with small businesses and real estate owners of all shapes and sizes. And in that time, I've developed these 5 core tax strategies that are my go-tos the first time I meet with a potential client, or even if I'm visiting with an existing client. Let's get into it. The 5 are an S-Corp, somewhere in your organizational chart. You need to know that the S-Corp benefits are there somewhere along the way. We'll talk about structure. The second is a 469 aggregation. This is a very specific tax code for business owners and real estate operators to take the most advantage of these business operations netting together. The third is a cost segregation study. You've heard a lot about cost segregation, so we're going to talk about the good, the bad, and the ugly, and how we use them. Next, the fourth is going to be this 199A qualified business income optimization. We're going to talk about what that is, where it came from, and how you as the owner can take the most benefit out of it. And the last one is operating agreement planning. The operating agreement is not a document you just throw in a drawer after you've set up your LLC. You want to get the most bang for your buck out of every dollar you spend, including the operating agreement. Let's get into it. We're going to start with using an S-Corp. If you followed me previously, you know that I'm not going to tell you to put all of your assets inside of an S-Corp. The last thing you want to do is to buy a heavy asset like real estate that has debt associated with it and put that inside of an S-Corp. There's a couple of different drawbacks of using an S-Corp for heavy asset and debt-related businesses. For example, you are not going to get the flexibility that you would otherwise have in a partnership if you need to distribute property. Property out of an S-Corp comes out at an appreciated or fair market value, creating phantom income. Partnerships don't have that problem. The second is then this problem with debt basis. So S-Corps will not give you credit for the debt that you have related to that property. Partnerships do. Partnerships will give you debt basis. That helps you take more losses to offset other income, and that helps you take tax-free distributions or tax-deferred distributions if you want to get technical. The third reason is that S-Corps aren't great for raising money. If you need to raise money from outside investors, S-Corps are fairly limited on the types of investors you can have in there, right? And so when we talk about appreciating assets or assets that have debt with them, we don't always use S-Corps. But S-Corps are really powerful for 2 main reasons. The first is this concept of self-employment tax savings. So S-Corps help you bifurcate or split out what income from a business should be subject to self-employment tax and what income shouldn't be. So the IRS has rules and regulations around setting a reasonable salary for yourself as the owner of an S-Corp. And so that reasonable salary you would pay FICA or self-employment tax on, very similar kind of tax. And the other piece outside of that standard salary or reasonable salary amount is free of FICA or free from self-employment tax, right? So this is step 1. This has always been the longest reason and the old school reason, if you will, for why you would use an S-Corp. The second really powerful reason to have an S-Corp in your organizational structure somewhere is this concept of qualified business income deduction. This was a brand new deduction that came out in 2017 for pass-through business owners. So if you get a K-1 from a partnership, you get a K-1 from an S-Corp, if you're a sole proprietorship or you're a disregarded LLC and it just goes on your 1040, you could be eligible for this type of deduction. This is a 20% deduction on the profit of your pass-through business before you pay tax on it. This can lower your top rate on pass-through business income from 37% to like 29%. It's a very powerful deduction. But to get the most out of it, you need to have certain qualifying criteria to maximize this. One of those is paying enough W-2 salaries. Now, if you're the sole owner of an S-Corp, there's only one person you can pay more salaries to, and that's yourself. And so we can use the S-Corp to potentially increase salaries as long as it's within a reasonable range, and you will increase the ability to take your qualified business income deduction. And so we want to use these benefits, QBI and self-employment tax mitigation, somewhere in our org chart. And that may look like having a partnership as the operations, having an S-Corp as the management company, and then having you at the top. Watch my last video I sent out. I sent out the ideal tax structure. This walks you through kind of how we use each structure here. But again, the number one thing I look at the first time I'm talking to a potential client, where's the S-Corp? How are we going to get the most out of QBI and limit self-employment tax without the S-Corp? This is what I look at. Number two, we're going to talk about this aggregation election. So this is code section 469, and there's really two types of 469 aggregations possible. One is specifically real estate. We're going to talk about the business one. So this business one lets you treat multiple activities as though they're one activity for you, the taxpayer. This is super powerful and super beneficial because you may have loss in one entity, tax losses in one entity, that you want to use to offset taxable income in the other. And if you own both the same, this makes perfect legal and tax sense. There's no reason to pay income tax on one business that's generating income and not have access to use these losses in the other entity if you own both the same. So there are specific rules that must be followed in a 469 aggregation election, but it's a very powerful tool. And so to use this and to strategize with this, I look at what are the LLCs. Let's lay this out in the org chart. What is going on? A common example is a real estate entity, like a rental real estate. You have your office building in one entity, and you may have the operations in another entity. Even if you own both 100%, they're very powerful tools to segregate this. You want to do this for, your lawyer may tell you to do it for risk reasons. But what you want to do here is make sure you're not losing the tax benefits. To follow this example, you may take bonus depreciation in your office rental building, and then you can use that if it's the right type of entity to offset your income in your operational business, right? And so you can accelerate deductions here for a new office or new improvements, or just do a cost seg that you haven't done yet. We're going to talk about this next. And then use that against your operational income, your traditional income. And it can help you accelerate the tax benefits that you should get and own for having your own real estate. But this isn't how it works automatically. You need to make this tax election. You need a 469 election. You need to follow the rules, right? So things get complicated here when you have multiple different types of owners in here. The ownership is unique and different. They're in different geographies, right? Or they're in different types of controlled ownership structures, right? Or they're not the same type of business. And so there are certain rules to follow in 469 to make this election, but it is incredibly powerful to maximize the ability to deduct as much loss as you can over here against active income in another type of business. Let's go to number 3, cost segregation studies. Cost segregation studies are really powerful tools to accelerate and capture as much of the tax benefit of owning real property and real estate as possible. We talked about it in our example. If you have a rental activity over here, a trader business, or a rental property here, and you have an operating business in this LLC, you can take a cost segregation study, which is a detailed engineered study done by professionals to line out all of the detailed components of that structure. And those detailed components of that structure are eligible for shorter and shorter depreciation lives than is the normal building structure. A quick example, you go and buy a rental property for your office. You're going to own the building and rent it to yourself. Well, that building is depreciated over 39 years. What that means is as the owner of that, you are entitled to a deduction over 39 years straight line of the basis or the cost of that building. If you want to accelerate that, you have to do a cost segregation study, or you should do a cost segregation study. And you can break out lives that are much shorter, 15 years, 7 years, 5 years, 3. You can break down these additional assets, furnitures and fixtures, landscaping, lighting, security, sidewalks, pavement, all these different unique components have much shorter depreciable lives. To boot, you can then make a bonus depreciation election if that's placed in service in the right kind of year, in the right time frame of that year. You can make a bonus depreciation election and take 100% bonus. Now these are the new rules against that property and offset, like I mentioned last example, all of your operating income activities. Right? This is extremely powerful. And there's a timing aspect to cost segregations too. So depending on if you raise money and buy a property, if you're a syndicator of real estate and you buy a property, well, another big determinant of who gets these losses is who's guaranteeing the debt. Is the debt guaranteed? How much is it guaranteed? Who gets those allocations of losses? All flow from who has the responsibility or the risk of loss. And so this is another thing we're talking about with our real estate clients, which is when do you do this cost segregation study? When do you use these losses, right? Who's going to get them? Do your limited partners want them? Or can you as the general partner and syndicator take advantage of them because you're guaranteeing debt? And so the cost segregation study is a great step one to understand the benefits of accelerating depreciation, but kind of like cost segregation 2.0 is then breaking down timing. When do you use this tool? And it's a very powerful tool. Next, let's talk about this 199A QBI optimization. We mentioned it already when talking about S-Corps, right? But we want to get the most bang for our buck to maximize our QBI deduction. This is a very powerful tool. We're taking our top tax rate from 37 to 29%. It's an incredible tax savings. But as I mentioned, there are two rules or two limitations that you're going to have when you make qualified business income over certain thresholds, right? And so what the IRS wants to do is measure against two different things. Let's say you make $1 million of qualified business income. What the IRS wants to see is that A, you've paid enough W-2 wages to earn that income. It's not just you're the only one there. And really what they're after is, did you pay FICA? They want to make sure that FICA is getting paid as a base to earn this qualified business income. And if you've paid enough FICA or have enough W-2 support to earn that income, you're not limited. The next one is then basis and assets. So you have this unadjusted basis and assets threshold, right? So these are two thresholds that you will get limited out on your qualified business income deduction by if you're not careful. This is where, again, we're back to step one, which is where's the S-Corp? The S-Corp helps you pay yourself, if you need to, more W-2 salaries, right? You cannot do this in a partnership. A partnership cannot pay its owner a W-2. That's a distribution or a guaranteed payment. Instead, an S-Corp can. So an S-Corp can increase this base amount, this threshold, whereby you are not limited in your qualified business income deduction. And the math works out. If you do the math, you're going to pay a little bit more in FICA to pay yourself more W-2, but the 20% income deduction is going to far outpace that cost. And so when we're talking about QBI optimization, this is a huge error or a miss I see in tax planning all the time. Hundreds of thousands, if not millions of dollars, are left on the table by countless small businesses and business owners just because they didn't have an S-Corp or they didn't increase their salary enough to optimize that amount. So optimizing your QBI deduction is not automatic. It takes some thought and some understanding to be done before the end of that tax year. The last one I'm going to talk about is operating agreement planning. I'm going to do more videos on this. I love talking about operating agreements. I live and breathe them. It is kind of where I've cut my teeth and really made my way and made a difference in my clients' lives. Operating agreements are a business agreement that you have usually when there's two or more partners or two or more members of an S-Corp or a partnership, right? And so when we talk about partnerships are really where so much of that value is driven in an operating agreement, where I can really add the most value here. And I look at these operating agreements for a couple of different things. The biggest one is this allocation language. Partnerships have very specific terminology and very specific types of ways that they can allocate their income. The two most common methods are the safe harbor method and the targeted capital account method. And don't worry, I'm going to do more videos on these different types of methods. But these are the two most common ways, and they have major differences in how income and loss get allocated. We talked about in cost segregation, the timing of it. Cost segregation 2.0 is timing of it. When do you use this? Same thing goes here. Safe harbor allocations have a very different timing of when you get the income, when you get the loss, what partners get the loss, where does that go, who gets that loss first, or who gets that income first. And so when you can start to change the operating agreement language and have very different impacts on what classes of partners or what partners get losses or distributions and profit first, and then when does the general partner come into play, it is an extremely powerful tool. 90% of the K1s that I look at a lot of times have ignored the operating agreement. As a CPA, as a tax preparer, I have to have the operating agreement, and I have to follow it. I have to follow the allocation language or risk injuring my client for breach of his contract, for breach of the operating agreement. The client has to make sure the taxes are prepared in accordance with that agreement. So I need that agreement. It needs to say the right language for me to then get the most bang for my buck for my client and allocate it properly. There's like 30 other things I look for in tax languages and operating agreements. We won't get all into them now, but just know that your operating agreement should be customized to you, should be customized to your deal, to this property, to your business, right? S-Corps have entirely different rules on the operating agreement language they can have in there. I could talk for hours on this, and I will do more videos on this. But that's it. Those are the 5 things that are the most powerful tax benefits that pass-through owners and real estate owners should know about and should be considering when they're filing tax returns, reviewing tax returns, or setting up tax planning, right? So let's run through them again. You need an S-Corp somewhere. Somewhere in your org chart, if you're making over $150,000 of profit, consider the use of an S-Corp somewhere in your organizational chart. The next is 469. The 469 election, how are we going to aggregate or bring together and compile these activities to where it's really seen as one activity for the IRS, which gives all these benefits to the owner. The next is cost segregation, right? We want to make sure that we're cost segregating our assets, our properties, and know when to use that cost segregation. It's not a slam dunk always immediately after acquisition you're going to do this cost segregation. You want to make sure that your LPs and you are aligned on this, right? The fourth is then this QBI deduction optimization, getting the most bang for your buck out of this 20% deduction that's there and is free for the taking. You just have to do a little bit of optimization and tweaking in your how you get paid out of the partnership, but it's there. And the last is look at your operating agreement. Operating agreement language can change an entire tax return for the better or for the worse. Those are the 5 things you got to take a look at. We'll do more videos on each of the ones. If you like this video, I would appreciate a thumbs up. I'd love a comment to hear what you like, what you didn't like, what you want to know more about, and subscribe to get more from me. We'll do it again. Thanks.